tell you, there's some good things about life insurance. And there's a few things that Mr. Dave Ramsey got wrong. And I think it's important that we talk about them because you can really get some good financial planning benefits from life insurance. That's right. Life insurance can pay you living benefits. So I say, let's get to it. Mr. Dave Ramsey, he and I disagree on a lot of stuff. And the reason that we do, the primary reason that we do, is he likes to have hard and fast rules about things that you should do with your money and products that are either good or bad. And my point of view is this: none of these products are either good or bad. They just are. You see, everything has both good and bad qualities. And all of these financial planning options are tools. Whether it's debt, a form of life insurance, an investment, a type of investment, they're all just tools. And if we know how the tool works, we can use it properly. Dave Ramsey telling you that one form of life insurance is either good or bad, well, I'm going to stick with the bad. Dave Ramsey telling you that one form of life insurance is bad is like saying a hacksaw is bad. A hacksaw is just a hacksaw. Now, if I'm actually going to be cutting down a tree, a big old tree, chances are I'm not going to pull out a hacksaw. I'm going to be there all day. I might get myself a nice big chainsaw. That would be a better tool for the job. And the same goes for life insurance. Dave Ramsey usually advocates to people that you buy term and invest the difference. This strategy comes from a company called Primerica. It used to be called A.L. Williams. Dave Ramsey worked for A.L. Williams for a short stint before he wrote his book. And as a result, that's where his education about life insurance ended. Me, I spent my entire career either working for insurance companies or investment firms. I've worked with brokers who represent all sorts of products from all sorts of companies. I have a more diverse background than Dave Ramsey. As a result, I can tell you that there are times where term life insurance is going to be your best bet, and there's other times that you might want to consider other forms of insurance, like a cash value life contract. So, to illustrate how these different life insurance products might work in your own portfolio, how they might work for you, I want to tell you a little story about my own use of life insurance. When I first started in the financial planning industry, I worked for an insurance company that offered something called a universal life contract. These contracts pay higher interest rates than your standard cash value or whole life contracts. Dave Ramsey in his book talks about both. Now, at the time that I worked for this insurance company, it was the late 80s, and interest rates were pretty high. In fact, I bought a universal life contract that had a guaranteed interest rate the very first year of 11%. Yes, 11%. The guaranteed interest rate on this contract, 5.5%. Now, at the time that I worked for this insurance company, and this might be the case for you too, my employer also offered me some term life insurance. Some of it for free, employer paid, I should say. And I could add on to that for very minimal premiums. So I did. I had two forms of insurance at the time. I had a term life insurance contract through my employer, and I bought a universal life contract for $85,000. Since I was 22, 23 at the time, that $85,000 universal life contract had a premium of $250. And this is benefit one to cash value life. Dave Ramsey in his book says don't buy cash value life because it costs you more. But you see, if you buy it early, the premiums stay the same. It ends up being a better deal long term. My premium for that contract remains at $250 a year, even though I happen to be in my 50s now. But you know what? I don't even have to pay that $250 premium because the cash value that's built up in that contract now pays the premium for me. Can you see where the benefits are racking up? Now, fast forward a few years. 10 years later, I still have my cash value life and I'm still working for an insurance company that gives me the term life insurance. But I get laid off. And this is when I decide to start my own business. Now, I'm still pretty young. I'm in my early 30s and I could have bought a replacement term life insurance policy for a pretty low premium. But I didn't. I had my cash value life and I had money in savings. You see, fast forward 10 years later, I had been putting money away, which is what I encourage you to do here, even before you pay off your debt. I'd been putting this money away, and so I could kind of self-insure for my life insurance. Now, I'll be honest with you. When I started my own business and I gave up that term life and I didn't buy any more of it, I was underinsured. I had 2 children at home and I had a husband at the time who didn't make as much money as me. And if I would have passed on at that stage, I would have left my kids without potentially enough money. So that's something that you want to consider. I got through those 2 years or 3 years or 4 years, whatever it was, until my savings got to the level I would have insured. Everybody with me? So, fast forward, I'm buying a house. I rented for a while when my kids went off to college. I wasn't sure where I wanted to live, so I rented. And then I decided it was time to buy a house. Now, I had some money in savings, but that money in savings was in some investments that were doing pretty well. I mean, after all, the last 5, 6, 7, several years, the stock market's done really well. Well over 10%. In fact, the last 2 years under Joe Biden, 20% returns. I hope it continues under Trump. Anyway, I digress. Now I need some money to buy my house. I need a down payment and money for some of the other expenses. And I could take money out of savings, but it's invested in the stock market and it's performing really well. So I decide to take a withdrawal from my cash value life insurance contract. You see, that's the benefit of a cash value life contract. Universal, whole life, whatever. You have a cash account in that policy that is growing tax deferred. You don't have to add the earnings in that account to your tax return. And it's your money. Now, you can take a policy loan against that cash value, but you can also just simply take a withdrawal. And this withdrawal is considered an early payment of the death benefit, which means it's income tax free. I took $10,000 out. It dropped my death benefit from the $85,000 to $75,000, but heck, that's okay. My kids are grown. I don't need to make sure that I have life insurance for them. And I have more than enough savings to pay off all my debts, my house, all of it when I die. So I don't really need the $85,000 in life insurance. Now I have a $75,000 policy and I had $10,000 to pay for the expenses for my new home. And I'd like you to also consider this. The premiums for my policy are optional. I have enough cash value in there to pay it. And if I want to put more money in, I can. Remember, my guaranteed interest rate on this was 5.5. And when interest rates in other places dropped significantly, and in a standard savings account or even in a money market, I could get 2 or under 2%, I was putting money in my cash value life where I was getting 5.5. Now, Dave Ramsey will tell you that these policies have extra fees above term insurance. They sure do. But those fees are adequately disclosed and you'll know what they are. And they also vary by company, so shop around. And here's going to be my final benefit to a cash value life contract. It's guaranteed. You see, if I start out with term life insurance and I get like a 10-year guaranteed policy or a 20-year guaranteed policy, when that guarantee runs out, my premiums go up. And if I still have a need for life insurance, I have to pay higher premiums. And do you know what else? If my health history changes and I can no longer qualify, I have to renew that other policy at really high premiums. Whereas had I bought a cash value life contract, those would have been guaranteed. So let's wrap it up with this. Point number 1, if you have life insurance through your employer, take advantage of it. Cash value life can offer you living benefits as well as the death benefit for your heirs. And point number 3, no program is totally good or bad. They're all just tools. And the more you know about the tools, the better able you are to use the proper tool at the right time. So thank you for stopping by. I ask you to subscribe to this channel so you can get more good information. Make sure you like this video and also comment or ask me some questions. I'm happy to help you out with your financial plans in any way that I can. Talk to you later.